And good morning, everybody. This is John. Happy Monday for those who are in South Florida. For the warm weather, great place to be. And for those that are in Chicago, it's a great day to trade because you're inside. And for those that are in Dallas, hopefully there's still some rock salt and you've buried out from the major ice storm, i.e. Butch. And we're going to start planning and scanning in just about 3 minutes, months, minutes, days, hours. It's all, that was trader's code for minutes, actually. But I want to make sure that the volume level is good. And Butch, could I get a sound check from you? Could you say something so I know that my speakers are working?
Okay, there we go. Yeah, you sound great. Sound good. Good morning.
So are we about on the same level here so people don't have to adjust? Of course, you wouldn't know what your sound level is to others, and I think it's great. Nicole says it's good. Ruth says it's good. Good morning, Ruth and Nicole. All right. Excellent. Good stuff. All right. We were in Fort Lauderdale Friday. We had a chance to meet a lot of faces, which was interesting. Faces that I hadn't seen in about 11 years. It was interesting because it wasn't quite a TradeStation event as much as it was an event hosted by TradeStation with a users group in Fort Lauderdale. And boy, it was neat to see a lot of old friendly faces and people that have known me through the years. So that was exciting. We saw people at George Valley, for example, and I mean, it was just an overall great thing. A guy had been a member of the SIBO and respected my work and had known about me, and he was just thrilled to see me in person. So it was really a nice, great event. And apart from the fact that since we're not recording, they still had no explanation of what happened to their outages or if anyone's going to get adjusted. So if Pat is here, Pat would know that we had a lot of, you may know that there were issues with TradeStation. It wasn't that their phone system went down, but their platform went down for over an hour. So if you had an order in, it didn't show that you got filled, and yet your dome reflected that you still had an order working. And if the market was below or above your entry, it didn't reflect a change in your P&L. So you didn't appear to have a trade on. And the interesting aspect is it was still generating live trade quotes off the dome. So it wasn't like it wasn't generating quotes. It wasn't reflecting that your trades had entered the market. That's a significant problem. So we'll see what transpires, and I'll keep you posted there. As part of you guys being our students, it's important to understand that things can and do go wrong in this business, and you got to be prepared. And keeping a level head. First thing we teach is you got to have a contact, someone that you can call, because if you're calling an order desk, let me tell you what happened with TradeStation while we're not recording here, but what happened with TradeStation is you call their toll-free number, it rang once and hung up. You call it again, it rang once, hung up. So then you called the local line, and it just rang and rang and rang. So if you finally got through, you got on hold saying your call will be taken in the order received. So then when you did get received, it was just some outsourced desk that says, oh, they'd ask for your name, rank, serial number, mother's maiden name, and all your password codes, and they say, okay, hold, and I'll put you to the trade desk. And all this time you think you're talking to the trade desk. Yeah. So, in fact, I called, thank God I have friends over there, like the senior VP and things of that nature, and the owner, and, and I got people I can call. They didn't even know they had an outage or a problem. That's incredible. So the moral of the story is you got to have a contact person, and every firm has had problems. I mean, every brokerage firm has had a problem because we're dealing with, if you're a brokerage firm, it's, you got to have connectivity. So it's not, maybe Bell South goes down or AT&T goes down or whoever your trunk line is with. I don't understand how it all works. I know how to turn a car on and drive, but I don't know what makes the engine run. Any event. All right, so we're going to get started here in a second. I just thought I'd give you a serious situation, a real-life situation that does happen, and you know what? You just move on. But this is a part of the hazards and what you need to do. Have a contact person that you can get a hold of. When you see, don't don't think, oh, I'm not in because I don't see it. You have to be proactive, and you've got to dig and investigate. That's one of the things I always say. Traders need to ask more questions. So, and I know we had people in this room that had issues trading with TradeStation on Thursday from about 9:50 Eastern Standard Time till about 11 a.m. Eastern. So that was about an hour and 5, 10, 15 minutes, something like that. So I sent a tweet out to warn people, hey, don't be putting trades on because it may not be accepted and there could be problems, or you may put the trade on and it may accept your order but not reflect on your dome, so you don't know if you're in or out or got filled. So that's why I sent that tweet to warn everybody. All right, so it is 9:03. Enough of that. PNS, it is 12/9/2013. So give me 2 seconds. Let me tee this recording session, and I'll be right there. Okay, we are recording. Thank you all for being here at Planning and Scanning. We're down here in South Florida, and we got a mentorship group coming in, or have them here in our South Florida office. So we're going to be doing a lot of exciting things today and this whole week. So it's neat to do a live broadcast in front of some students, and we're going to share with them exactly what we talk about each and every week. First off, let's take a look at the health and the breadth of the market like we normally do. And then I want to take a look at some commodity markets in general. Then I'm going to take a look at some of the sectors and some stocks that I think we ought to be paying attention to. Last week we had an amazing trading week, mainly trading some crude oil, some gold, and of course the S&P. So a timely event in covering and liquidating any short positions that we had put on from the prior week, and not only TZA, but some credit call spreads and IWM. And I hope everyone participated or at least benefited and saw how that we got that information together. And it was discussed right here at this planning and scanning session that we do each and every Monday. Now, let's take a look at what happened on Friday with the unemployment report. And I know that in the live trading room on Friday, there was some really good analysis. And Butch, who of course runs the day trading sessions, correctly identified a market pullback to the 60-minute moving average, as well as some old support resistance areas that was around the, if I distinctly remember, around the 94, 95 handle. And all of a sudden we saw a little bit of what we call disassociation amongst the indices. In other words, the NASDAQ was outperforming the other indices, and the NASDAQ is still outperforming the other indices. So let's take a look at the NASDAQ right now and give you what I mean by outperforming. As you can see, this is a daily chart. This is the NASDAQ futures. Now, the cash market is not open when we go through these, but from a futures perspective, I like to look at the futures mainly because it does not allow for the gaps in the market, and you can see the overall trends of the market. And since the NASDAQ 100 futures trades off the cash, it's more worthy to trade or watch or analyze based off the futures at times. So with that said, I also, on this chart in the middle section, most of you know this is the advanced decline comparative ratio line that is exclusive to the NASDAQ. Now, we have seen, and I want to point this out because this is kind of a scary situation for those that are bullish. When I said it was outperforming, it never, the NASDAQ never declined in the last few days like we saw in the Russell, like we saw in the Dow. It was lingering at support, and many thought maybe it's because of the effect of Apple. And that's why we use an advanced decline, because then we can take a look and say, okay, well, if that's true, then why do we see the advanced decline going and moving lower if Apple is the one sole responsibility, and a few other stocks the sole responsibility for keeping this index strong, as you can see, moving higher? We're not seeing a majority of stocks participating in this rally. So in addition to that, we look at the volume analysis, and I don't use volume histogram bars, and I teach. We're very, very unique in our university and our studies and our teachings, that we want to keep you guys abreast of the best indicators and the methodologies that work in our current time. People are out there teaching and training. Even here in Fort Lauderdale this past weekend, I asked a group, a very large investment group, how many people have struggled with volume when it comes to market analysis, and literally the active traders in the room, some of the old timers that have been around a while, they are struggling. I would say maybe half the group raised their hand. The other half were maybe new traders, didn't know, afraid to ask, et cetera, et cetera. And I said, please participate in this, because it's important to understand when you're trading, you have the advantage when you come to these types of groups, or when we conduct these types of planning and scannings, to get people to say, yeah, I've had problems. And then someone else says, yeah, me too. Now all of a sudden what you got is you got this unique information that you know that you're not alone. And if others are struggling with it, and they're only at this group or in our meeting or at our gathering on planning and scannings, how many people out there in the real world trading are clueless and are still doing the same mistake over and over, expecting different results? Millions. Millions don't have this type of information. So if you think about the dark pools where Goldman Sachs can buy and sell a stock to their own group in their own black box type of or dark pool order entry system, or we have, more importantly, option derivatives that we can do what? Sell a put, buy a call, you're in a synthetic long. It's not going to reflect in the overall volume. So we see uptrends on declining volume that can last for very long periods of time, and that's what we've seen in the last 5 years. And it's becoming more evident as every week or month and other markets start to evolve in trending conditions. So the best tool that we've been teaching for several years has been on balance volume, because it reflects the trend changes. In fact, I have PowerPoint presentations that I've done that I went back in 2008 to describe this at a Traders Expo. And the interesting aspect is that with the on-balance volume, it gives us a better identification of the strength of a trend when prices go up and it's on stronger volume versus prices going down. So if we take a look at that theory, and you see that this stock market in the NASDAQ, the one that's leading the market higher, what's happening here is it's not leading the market higher on even on-balance volume increase. So to me, we have probably midweek, if we do not see, if we see higher prices, we close higher today, and we do not take out the advanced decline in the NASDAQ, we're building a very strong situation where we could have a bearish divergence pattern. Now, we only have, if we take a look at our calendar, so if you open up your calendars and you take a look at the rest of the year, not many people are going to be trading on the week of December 23rd, beginning of December 23rd. It's Emperor's birthday in Japan. It's Christmas Eve here. It's Christmas. It's Boxing Day in Europe, and that leaves you Friday, You come back Monday to do any last-minute trades, and then you have New Year's Eve on the 31st on a Tuesday. So if you're going to do any real trading, any trade adjustments, any portfolio adjustments, I think the volatility that we saw in crude oil, the volatility in gold, we are starting to see a lot of these hedge funds in the commodity-related markets have adjusted their portfolios already last week and may continue to do so this week in markets that no one's watching or paying attention to. Perhaps it's copper, natural gas, grains, meats, things of that nature. You start to see kind of like the light switch where they say, okay, let's get out of coffee. We're in a long trending position in short gold. Let's cover some short gold. So you saw those huge explosive short covering moves. A hedge fund or a commodity trading pool operator or anyone that's operating based on performance, that's incentive fees. You get a management fee to manage the money, and you get a performance percentage fee. And some fees have been as high as, believe it or not, 50%. Was it Cohen that's a little bit in trouble with the SEC because of maybe some insider trading, right? Yeah. And his hedge fund was something like, if I'm not mistaken, I mean, it's a Monday morning, but I think he was charging something like 8 or 9% management fee and almost 50% of the percentage of profits because he could, because they were trading that well. So I'm not saying everyone's like that, but most of the hedge funds are paid on a quarterly basis. No one ever said, and we've been teaching this at our seminars for a lot, decades. I think since back in the early days in Las Vegas, showing people that these are the moves that you get. So I think last week, which is beginning of the month, if you take a look at it's the beginning of the month, it's the last month of the quarter, we're going to start to see some volatility, and then it dies out. Now, we had the unemployment report out. We're done with that. We've got some economic numbers. We got some earnings out this week. I think Costco's out, double checking that one. We've got retail sales. It's going to be fairly important to see if consumers were spending last month. But I think the biggest number of all is going to be looking at, believe it or not, this particular week is looking at not just weekly unemployment numbers, but business inventories. If inventories are going down, it shows strong demand. If inventories are building, it might show that there was good manufacturing in the past, but in order to see demand, inventories have to go down. So we want to pay attention to, if GDP is going to be strong, then business inventories have to go down. That means there's demand. So GDP might have been strong in the past because people stocked up on the shelves in order to prepare for big demand coming, but if there's no big demand, then inventories remain high. So you watch in the next few weeks, in the next month, you got to watch weekly unemployment reports, you got to watch business inventories, and that's what we really should be focusing in on to find out if we definitely have a stronger economy moving forward. And why is that important? A stronger economy, more job growth. What does that translate to? Higher interest rates. What does that translate to? The stock market reeling that the fact that all of this infusion of liquidity may come to an end, and that the stock market is going to have to trade higher on its own merits. And we all know that not all stocks have been created equally in this environment, and we've seen only proportionately, not all stocks are racing, making new highs. And so we've seen a major sector rotation. We've been with this theme for quite some time in our Trading Triggers room. We've been talking about certain sectors to remain focused in. Some focused sectors that we've been identifying that have remained the strongest sectors have been the regional banks. Regional banks make loans to small businesses. Small businesses, what do? They don't really work out of their house. They may rent a property at a retail outlet mall or a retail mall. So as businesses build, as lawyers build their businesses, as professionals, doctors, organizations start to build businesses, they're not working out of their home through the internet. These are services that need to provide spaces of operation in businesses. Therefore, commercial real estate might be on the rebound. And we talked about a few names in the real estate investment trust REITs. We've talked about even at PA Stock Alerts, which we had a nice call but we gave up on it. It was Richard Ellis, CBG. We also have some today, CLI, that I'm going to talk about, and I'll get into the stocks. But what I'm really concerned about in the market is, and I want you guys to focus in this, if in the next, say by Wednesday, so we got Monday, Tuesday, Wednesday. If Wednesday we made a high and it fails, and we can't make and take out new highs in the advanced decline on the NASDAQ, which has been the leader of the rally over the last 2 weeks. See that NASDAQ's made new highs. Let's take a look at the S&Ps real quick. S&Ps haven't made a new high. Look at that advanced decline I'm sharing with you. And oh, by the way, here's a great example of what this volume has done to traders. Volume has gone down in a downtrend, and on-balance volume has gone in an uptrend until probably, I would have to say, this area right in here. We're starting to see a sideways flat action and on-balance volume, which is kind of interesting because now we're starting to see an increase in the volume histogram bars. But I think what we want to focus in on is to see if this market makes new highs and can't sustain new highs on any uptick in on-balance volume, then I think this could have been just a short covering pop in the market. And more importantly, look at this on the advanced decline on the S&Ps. You're pretty much trading near the high that we established at 1812.5, which was a Friday, the day after Thanksgiving, very illiquid market condition. And if we take that high out, and you don't take the high out on the advanced decline in the S&Ps, now I got two markets that are telling me there's a problem. All right, so let's switch over here and look at the Russell, the January effect. Typically, people start to buy small cap stocks. And the Russell, as you can see, it really didn't have a chance to move up. It only moved up Friday. It stalled at monthly pivot. So if we see it, if we take out this high, if we take out the high, and we don't see an uptick in the advanced decline by midweek, give it a couple days, and there's no volume associated with it, friends, this is not a very good scene or situation going into the first of the year. Now, we only really have this week and next week to really trade. And so what we want to focus in by next week's planning and scanning, what we want to focus in on is the dog stocks that are near 52-week lows that haven't moved at all. And not only near 52-week lows, but we want to see if there's any tax credit selling. So we will have that list available for our TTU members and for planning and scanning members as well. All right? So I'll put that list together with you. So this is the NYSE. And I'm looking at the NYSE and I go, gee, on a daily basis, it's not even close to its highs. So if you give it a couple more days and there's no pop in volume, or if the advanced decline can't follow suit, then that's not a very positive situation. So let's go over here and look at the YM. Granted, we did form high closed dojis on a daily basis, but how many times high closed doji is about a 72% probability of success, and it does tell you that the market may move up. It just doesn't tell you how high. The fact is that the market gave a high closed doji on a 3-day decline is not as significant as a high closed doji after maybe a 2-week decline and a major move in price. There's a big difference. In order to see an action or a reaction, there had to be an action. There was not a lot of action to the downside, so I'm a little suspect of this, and that's why I keep pressing this 2-3 day thing, because you're going to need the market to have maybe people read the news, so you get into Monday and say, gee, this is great, and then all of a sudden you got maybe some Fed speakers out today. You get another day that people sit there and say, well, let me get some money together. I got to throw it in the game. You know, after about 2 or 3 days, we can't see a positive reaction out of the market based on really good economic numbers, and the market internals don't reflect that, and there's no volume. Friends, I think, you know, we've got a real concern for the market going into January. So, and that's a daily basis, so you need to pay attention to these numbers. Now, here is the fact that we're trading at or near, which is an area of interest, the quarterly pivot resistance. The advance, this is a weekly chart. The advanced decline, even longer term, has got probably institutional traders, because they do look at the dailies, but they're more interested in the higher degree time frame. So institutions will be looking at these weekly numbers. It's flatlined and moved lower. And if I get rid of the quarterly, you can the quarterly pivots, you can see in weekly basis in terms of market conditions, we had a doji 2 weeks ago, a doji last week. So yeah, we might see higher prices. The question is this sustainable? The NASDAQ without the participation, and it has a very similar makeup with the advanced decline. Folks, it is not accelerating. So you've had how many weeks now? Since November 15th, and you went through December 6th of higher closing prices, and you don't have a market participation, and it's flatlined and actually gone negative, is not, I mean, negative is the opposite of positive. So let's take a look at the Russell. I mean, you could say that this is a kind of a some people call that a hanging man formation, and we didn't see follow through on the advanced decline. Volume is a very similar picture here. And then last but second to last, let's take a look at the New York Stock Exchange Composite Index. We came very close to forming a low close doji, and we missed it. So this is the bar number 1, bar number 2. So you got maybe another week that you could form a low close doji, but look at the advanced decline. Did not move higher, and it's on lighter volume. So one other aspect that we're looking at here, let's take a look at the Dow. And the Dow, similar situation. And I've noticed that all of these indexes are near quarterly pivot resistance. So I give it a couple more days that we got to look to see what transpires, because if the market does move up and you start to see more money pulling into the market, that's showing there's strong breadth, and if it's on good volume, that tells me that we could be prepared for a second leg higher, and that means sharply higher prices. If I'm going to commit new money into the market, I want confirmation. You got to admit, we're up like what, 27% in the S&Ps this year, right? So committing new money for an extra 2 or 3%, it's going to take a lot of evidence to see that. So let me go and switch charts here. And I mean, I now have reasons to suspect that on any further rally, I don't feel, based on the evidence that we have right now, that if the S&Ps pop, and let's say we take out the highs, and we go to like 1815, 1820, 1825, I'm more interested in doing the January credit call spreads, as we wrote about in the newsletter, up at that level. And I think that those for January expiration is going to be a smart play. So I am looking to see if we could pop on any positive follow through. The fact that we have weakness with the advanced decline shares with me that I think that that's going to be a good trade. And more importantly, because as you get into next week, you got the FOMC. I'm sure Ben Bernanke is going to have to, and the Fed is going to have to say, okay, we're not going to do anything right yet, but they are going to have to make an adjustment statement. We're seeing improvement in the economy. They're going to have to meet up with the demands of investors to saying, when are you getting off the train ride? What are the conditions? Otherwise, no one's going to trust the Fed, because now Ben Bernanke has said one thing in June, said another thing in August. Now he's got to say something. We got Janet Yellen coming in. He's going out, and this is going to be a big mess. And the stock market does not need a big mess. So they're going to make a statement, at least to talk about it. They have to. And I think at this point in time, that's what the real fear of the stock market is at this point in time. Now, let's say you got that doubt, that uncertainty. We still have to deal with our folks up in Washington, whether you're a Democrat or Republican. It's despicable. They're going to have to, I mean, God forbid there's a miracle and the spirit of Christmas gets in each and every one of these politicians' hearts, and they decide to get our budgets balanced. That would be an interesting twist of fate. But we still have to deal with that situation at the beginning of the year, and you've got a lot of theta time decay coming into the marketplace. So that's why I like the credit call spreads, defined risk strategy going into the month of January. So for the January expiration, and it would have to be this week, because let's face it, you know, the first week of January, we're going to have some interesting market components to deal with. And there's a lot of folks that are just itching to take some profits off the table in the market. They just don't want to get that tax liability in the marketplace. All right, so there's my explanation of what I'm looking for in the market on a more longer term this week and into next week, and what strategy I'm looking to implement. Credit call spreads on spiders for January on any increase in price. So now let's take a look at some scanning and planning some stocks here that I have in store for us today for this week to take a look at for maybe some short term. All right, so this is Tesla. Someone asked me about Tesla, and I said, you know, Tesla's not in my business plan. It's just a momentum trade. You might as well, you know, day trade crude oil and S&Ps. You can, you know, you can trade this off a 60-minute chart. It's, you know, it's going to be generating a potential monthly sell signal. So I think rallies to a $1.50, $1.57 zone is going to be resistance up in there. So look at the monthly moving average up in there. The first test up to 157, let's call it 157 and 164. The first test up there might give some overhead resistance selling, short-term selling opportunity. So I just thought I'd say that to you. All right, so let's take a look at a couple names that I do like. And number one, it's not a confusing situation that the stock market might be overvalued in certain areas, but the commercial real estate area, REITs, they're the ones, if we take a quick look at the one that we were talking about with planning and scanning is CBG, or with PA Stock Alerts. CBG generated a monthly buy signal. It broke out, and it broke out on a weekly basis and a daily basis, and it has strong volume to the upside. Another REIT that I really like, CLI. So let's focus on CLI. When I take a look at a sector, it hasn't performed with the market. This is negative on the year. This is going to be one that's on, without a doubt, if we're looking for sector stocks that have been beaten up, you have a potential for a massive double bottom from the lows of 2009. So if there is some recovery, I mean, there's a lot of air to the upside in this name. All right? So this is Matt Cali Realty Corporation. This is in the real estate investment property management segment of the market. You had on a monthly basis a nice, a potential less than 8% open close relationship. So we do call it a doji. You're forming almost a longer term high close doji. This stock, looking at it and this segment, we did form, by the way, you take a look at this is a doji. This is a high of 2037. The next time was 2036. Missed it by 1 penny. Less than is not equal to, is not greater than. They're all three different terminologies. But last week, we did form a PPS buy signal, high close doji, and finally got something that looks appealing. What do we have? A pop in on balance volume. So this might be a good name that you take a look at. It certainly has some low risk. It might be some dog money. In other words, you know, you look for a small pullback into the market, maybe 50, 70 cents, something like that, small risk. Dog money means it probably isn't going to accelerate to the upside till the end of the year, but, you know, the one interesting aspect is take a look at the seasonality. It bottoms in late November, which just passed, which it just did, and it moves higher in a seasonal trend going into April. So if all the forces are at stake, and we have that, again, the theme as I started off, sector rotation, you're going to see high-flying stocks that have large cap weight to the indexes. Indexes go down, but not all stocks will go down. They might take money off the table in some areas and put it to work in others. So that's why I think this space looks pretty promising rather than looking at Toll Brothers in the home builders sector. I like the real estate. If the small businesses are appreciating or increasing, if women are going back to the workforce, remember I've been talking about looking at apparel, retail apparel, not for men, but for women. Women get shoes, they get accessories, they get dressed up, and they go to work. So you're starting to see that segment of the market. So I just wanted to say there is another stock I like. If we do see more people going back to work, this popped up on my radar stream, multimedia games. It is in gambling sector. It formed a high close doji on a weekly basis near monthly support. But this might be what we consider a little benchmark formation. So I would say let's take a look for any pullbacks back. We'd need to see, I don't think we're going to see exactly midpoint, but maybe around the 20. Let's put an alert at around 29, and watch for if it pulls back with no concernable volume. In other words, it pulls back and it doesn't have any major destructive volume making new or lows, then I'm kind of liking this space, because we've been talking about these names like MGM and talking about Wynn. And someone talked about this the other day. They said, well, isn't this a lot of exposure to China? And it's like, okay, well, MGM doesn't have as much exposure to Wynn and Las Vegas Sands, but what you are seeing is room rates in Las Vegas increase, room occupancy increasing, and you're starting to see people return to Las Vegas. You're also seeing, believe it or not, more commercials right now for Las Vegas on TV than I have seen in a long time. So it's not one name that's moving up. The sector is moving up. So I like that name, MGAM. And one of the reasons is it popped us up into a high closed doji. So if we're looking at a pattern, the regional banks, which have had a tremendous move to the upside, we shared about that kind of wedge formation and looking for a breakout in gold last week. We gave that lesson, and the trade setups that occurred on Wednesday and again on Friday. And we are actually developing that same type of pattern on a longer term scale in a name like Zion. But I wouldn't be interested in Zion until we actually start to break out above this little swing high up here around 30 bucks. And one of the reasons that I say that, I need to see this market, and we'll point this up to you, Zion, on a daily chart. I want to see us take out that doji high right there. Not this one, that one right there. So I want to see that doji high taken out, and I want to see it taken out with some good volume. So that's an area that, if you think about it, let's take a look at the quarterly. That was it's got a little air to the upside. I'm sure you would agree with me. It's got a lot of air to the upside. So the regional banks, while they look like they've had a great performance this year, they have a lot of performance to the upside. Once they break out of swing highs, there's a swing high like they did back in the 90s. I'm not saying that, I mean, we're due for a move like that in this sector. I just think it's something that a lot of people aren't focusing in on, but we have monthly moves. We've got on-balance volume agreeing with that move, saying that this is not a small one-day wonder type of market move. So I like the regional bank still. One of the names that popped up is, of course, Zion. So for this week, we've given a couple names to look at. Another thing that I would say, there is a company called SEE. It's in the packaging. You know, these aren't maybe swing trades or weekly trades that you may want to look at as much as maybe position trades going into the next few weeks or next year. But from a seasonal perspective, it certainly moves and continues higher. It's in paper packaging. C, I'm going to have to look for a pullback, but it had a high closed doji. Again, this is a weekly chart several weeks ago, and it just continues to perform on relatively strong volume. I would have to say we're going to need to look for a pullback in that. The other stock that competes with that, BMS, right? It's doing something actually kind of exciting. It's consolidating after a rally. So why is that exciting? Because typically after a rally, if it starts to break out to the upside, what do? Trend consolidation. We're going to resume the trend, or we're going to reverse the trend. And if we are starting to see orders build, then this market will maybe give us a better, clearer picture. So we've got several good trade ideas set up for you this week, and for planning and scanning. And I look forward, if you guys need any more information or have stocks, sectors that you would like us to look at, simply send us an email or post it in the room, and we'll get on it for you, and we'll discuss it next week. I went a little bit over time there with you, but we had some really, I think, important information to share. And then we'll come back in maybe Wednesday morning to see how Tuesday turnaround worked, and to see what these advanced declines look like for you guys if needed. All right, so thank you all very much, and have a great trading week, everyone. And we now have students here, in our mentoring. We're going to get busy. We've got our sleeves rolled up. So watch for further upside and see if there's some follow through to the upside. The key to the game is going to be watching the market internals, the advanced decline, watching that volume to see if these moves are sustainable. And it's not just in the S&Ps. We need to see it as a broad-based rally in the top 6 indexes that we're watching and following, that we trade and teach with you guys. Have a great trading week, everyone. Thank you.